1, depreciation 3, supervisor salary 2, and general factory overhead 10. So it costs them 30 per unit, right? Now, the special equipment that make this 4A part has no resale value. It is worthless. They can just dump that one. The total amount of general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected, right? So general factory overhead would not change. That is unavoidable. So the 30 unit per cost is based on 20,000 parts each year. One supplier says that he will be providing you at 25. So at a glance, it looks like it's a very perfect decision. It costs us $30, and this outsider guy is selling us 25. You should accept the offer, but let's make decision based on relevant costing. So relevant costing says if we buy that one or if we make that one, right? If we make, we will be incurring 20,000 units multiplied by 9 with the direct material, and our direct material going to be this much, our labor going to be this much. So we will be not paying the depreciation. Depreciation is sunk cost, so we avoid sunk cost. So rather going into this value, just add this value, 9 plus 5 plus 1, this 3, we are not including that, plus general factory overhead, because question says the general factory overhead will not be affected. So that will be unavoidable. So unavoidable costs are irrelevant. So you delete that one. So how much it cost us to make? 9 plus 5 plus 1, 15, 15 and 2, 17. So in real sense, it cost us 17. An outsider is selling us at 25. So which one is better? Buy from outsider and pay 25 or make at 17? Of course, we prefer to make our own sell because depreciation is sunk cost plus the general factory overhead is unavoidable. So it costs, should we make that? Yes, we should continue to make that because if we just avoid this depreciation and this one, then it costs us 17 as compared to 25. Simple. So what is the opportunity cost? Simple. The cost of choosing next best alternative is called opportunity cost. Simple. We already discussed in our economics and all the stuff, so I'm not going to spend more time here. So opportunity cost basically are not actual cash outflow. You don't have to pay hard cash, right? And they are also not recorded in accounting, but they are based on making decision, right? So how would this affect the companies here? So opportunity cost is that if they purchase, the opportunity cost is the make cost, which is 17. If they don't purchase, then the opportunity cost would be 25. Simple. The next best alternative, that's it. Now our last learning objective is, which is prepare an analysis showing whether special order should be accepted or not. What is special order? A special order is a one-time order which do not affect your normal business practice. Remember this one, it's a special order, which is just one-time order, and it does not affect your existing fixed costs, existing rent or anything else, right? So it's like that when analyzing special order, only the incremental cost and benefits should be relevant. That's it. All other become irrelevant. Let's see the example here. So we have Jet Incorporation, which make a single product whose normal selling price is 20 per unit. A foreign distributor, you want to purchase 3,000 units and he offer you $10. And you will say that, look, it's crazy. Our price is 20 and you are asking us to sell you at $10? No way. But if you understand the managerial accounting, if you think at margin, rational people think at margin, right? Remember our economics rule. So you will be doing some calculation. Remember, this is a one-time order. It means your regular business is not going to be affected. Your existing customer may not know that you sold to other customer at $10. So only incremental cost is going to be used. So remember, you have annual capacity of 10,000 units. Annually, you can make 10,000 units, and you are right now making 5,000 units. So do you still have the capacity to make? You have 5,000 idle capacity. You can still make that product. Let's see that, whether we have the ample information or not. So this is Jet Incorporation income statement. So their price is 20. So only incremental. So if they make 3,000 more, would be needing direct material? Yes. Would they be needing direct labor? Yes. Manufacturing overhead? And would they be needing marketing cost? No, because this is one-time order. The foreign distributor automatically contacted them. They don't have to pay the marketing cost. Fixed costs remain the same, so fixed cost is not going to be used, right? So let's see the answer here. See, the only costs that are relevant, so you see here, if we just, on a broader scale, let me just delete the value from here. Oh, sorry. We just find out what is our sale price and what is our variable cost, which is our CM, right? Our sale price 20 and what our CM is 60,000. Our variable cost is 40,000. So if we divide it by 5,000 units, it would be 8. So look at that, our incremental value, even though we are using this marketing cost as well. In ideal sense, we do not include the marketing cost, but even though if we are using this marketing cost, even then it cost us $8 and he's offering us $10. Remember, fixed cost, we are not going to use that one. Why? Because existing business is not going to be disrupted. We still have the capacity to fulfill the order. Well, we have capacity of 10,000, 5,000 we are utilizing, we still have, and he's asking only 3,000. So 8,000 total capacity, we can still make that, right? So even if we avoid this $1 of marketing cost, so our variable cost would be 7. Even then, it is a profitable stuff, right? 10 greater than 7 and 8. So we just accept this order. That's it. So if Jet accepts the order, the incremental revenue will exceed the incremental cost. So it means the net operating income increased by 6,000. Simple. He gave us 3,000 multiplied by 10, $30,000 worth of order. And what is the incremental cost? 24,000. It is still profitable, right? So the answer is because this is a special order, one-time order. Our existing customer will not know that we sell to this particular customer half of the price. Otherwise, they would be very unhappy and it will cost us the business. So that's why the definition of special order is that it's the one-time order and our existing business is not going to be disturbed. So similarly, we can also use a quick check here. Ideally, it is a breakout room activity. Today, we already have 2 breakout room activities, so I'm not gonna waste so much time. We still have a little time here. So I'm just gonna do that. So we have Northern Optical Ordinary, we have Northern Optical Company, which is ordinarily sells X lens for $50. The variable cost is $10. The fixed cost is 18. Fixed cost is 18. And the variable cost of selling is 1. A customer has requested a special order of 10,000 units of X lenses to be imprinted with the customer's logo, customer logo. The special order would not involve any selling cost, so we can avoid this $1. But Northern Optical would have to purchase the equipment which can imprint the logo worth of 50,000, right? So let's see that. So what is the rock bottom price that should be, quoted to the customer? In other words, below what price would Northern Optical actually be losing money on the sale? There is ample capacity. So if you see here, simple, that their market price is $50, but we are not looking at the market price. So this information is unnecessary. The variable cost is 10, right? 10. The fixed cost is 18, so we are not including the fixed cost. Why? Because this is one-time order and fixed cost is not going to be disturbed. Selling cost is going to be avoidable, right? They say that we can avoid this. Okay. Now they have ordered us 10,000 and we have to purchase special machine printing. So if you see 50,000 divided by units, the order is 5,000, sorry, 10,000. So it means 5. So 10 plus 5 is 15, right? So above 15, if the customer pay us above 15, we will accept the order. Simple. Right, Subhan? Understand? Ali, understand?
Yes, sir.
So this is the beauty of using relevant costing and deciding that one. So don't look at the price. Price is 50. Now some students can say that, look, sir, 50 is a huge price and you are ready to sell at $16 minimum or 15 point, even $1. It is still profitable, right? Look at the discrepancy here. But that is the beauty of marginal costing or relevant costing, right? So we would be having this. So I just want you to pause the video and read this question. It's very simple, in which you are given, the idle capacity, and you have to find out whether at which point, you are ready to sell or not. Okay. So it looks big question, but question solution is very small. Let me show you the question, the solution as well. So make or buy decision is here. And there is also a cost, cost of part one, and this is like that. So let me just go back one more time, pause the video here, try to do it by yourself and compare your answer from here, and that's all. So that's all for our today's lecture. I would be uploading the assignment 5. So please respect the due date. Due date is our next class, before the next class. Okay, everyone, before the next class. Okay, all the the particulars are there. It should be handwritten, and you need to submit in Word document by renaming it. So if you have any other question, you can ask. If you don't understand something, you can ask. Those who are watching online, if you don't understand something, please do message us in our WeChat group. I would be happy to answer. Subhan, Ali, any question?
No, sir. Thank you so much.
Okay. So see you in next class. We will be starting a new chapter. Until then, stay safe, stay healthy, take care. Bye-bye.
Thank you. See you.
Bye-bye. Bye-bye, Ali.